you were able to do what you did with the pandemic program because of the flexibility of that program. So it's been heavily skewed towards Italy for now, for example. Long term, it's still bound by the capital key. Your colleague, Francois Villeroy de Galhau, said yesterday that the capital key is an uncalled for constraint on the pandemic program. In other words, it should probably be abolished. What's your view on that?
Well, I think that we have our rules, and we have said very clearly, what are going to be, the principles that we're going to apply. With respect to the PEPP, the Pandemic Emergency Program, what I have to say is that it's going to be an emergency program and it's going to be temporary, and we are going to use all the flexibility that is embedded in our rules. And I think that we are doing that. And so far, you have seen that the evolution of markets has been positive. So far, and I hope, and I am totally sure.
But are you open to abolishing the capital key?
Well, it's something that we have not discussed in the Governing Council. I can assure you that the capital key is a reference that we have there, but simultaneously we have flexibility, and we have flexibility in the short term, not only in terms of the assets we purchase, we buy, but as well in terms of the timing of the purchases, that I think that sometimes is much more relevant. But now, well, the evolution of sovereign markets is much more quiet and calm.
Well, it is now, but we don't know if we're going to get a second wave. Thin markets over the summer. There's always the chance of a surprise, a shock. One thing you haven't yet announced for the public, for the PEP, is reinvestments. This is something I think a lot of people in the market expect has got to happen. Does it have to happen?
Well, theoretically, the program lasts until year end, and afterwards we will see. We have not decided anything on that yet, but I suppose that we will do it. But we have time. We have time to do that.
It can't possibly end December 31st, though, can it? Because we won't know whether there's going to be a second wave in the next winter.
Well, who knows? There is a variable that an exogenous variable that is the evolution of the pandemic. But now, if you look at the evolution of markets, the sentiment of the markets is much better than it was only 1 month ago. And I think that it has to do with the evolution of the pandemic, that the flattening of the infection curve. Well, I don't know what's going to happen with the potential second wave. That would be very detrimental to everything. But my view is that markets are going to be driven by the recovery of the economy once the worst of the pandemic is over. I think that this is going to be extremely important for everything.
You note in the Financial Stability Review that low interest rates are a burden on banks and insurers. You said this in the previous Financial Stability Review as well, and so now we're probably going to have low rates for longer. It's more of a burden. It erodes the profitability of banks. It threatens the solvency of some insurers, as you said. Does that suggest then, in terms of monetary policy, you want to stay away from any more interest rate cuts, focus everything on bond purchases instead?
Well, our approach with respect to the impact of the low for longer in terms of interest rates is that the real cause and the real drivers of the low profitability of the banks is not our monetary policy. It's much more structural. Our structural reasons behind, for instance, excess capacity, a cost-to-income ratio that is very high, so that even when you look at the pros and the cons of our monetary policy, well, our monetary policy was positive in terms, for instance, of reducing the provisioning of the banks, because of the recovery driven and triggered by our monetary policy. So when you put together and in a balanced way the pros and cons of our monetary policy, what you can see, what you can regard is that at the end of the day, the monetary policy is not the real cause of the low profit.
It is acknowledged that the longer those low rates last, the bigger the problem becomes as assets roll off banks' balance sheets, etc., and they replace them.
But I think that now, there is no alternative to this monetary policy that we are delivering, in terms of the programs, of our purchase programs, in terms of the liquidity that we are, provisioning and we are giving to them.
But do you see a case at all for cutting rates more? Or is your preferred?
Well, that's not the approach that we have now. We are focused on delivering the delivery of liquidity to the banks in very good conditions and with a very good pricing, as you know. and simultaneously, well, our purchase program that I think that it has, a real impact on the market conditions.